All right, everyone, so we're going to jump back in here. This is chapter 10, short selling momentum stocks. So this is a little different from chapter 9 on reversal trading, although, as always, there's some overlap. Sometimes shorting a momentum stock will, in fact, be a reversal setup if we're shorting it off the top. But this chapter really applies a little more specifically to essentially the inverse of my momentum strategy that I trade on these parabolic stocks that are moving really, really quickly, and focusing on trading those same stocks to the short side. All right, so why don't we jump in here? So today you're going to learn how to take short positions on momentum stocks. And when I talk about momentum stocks, I'm typically referring to stocks that are moving up really quickly, although we could apply these strategies to stocks with momentum going down and shorting for continuation, but we're going to be primarily talking about stocks that are squeezing up, since that's what we see more often. Now, the reason why I'm going to teach this strategy, but you won't see me trading it a whole lot, is for a couple of reasons. Number one, the availability of shares to borrow is always a challenge with small caps. Now, there are some brokers out there that do have better accessibility of shares to borrow, but often you have to pay a fee to reserve those shares. And they have a limited number of shares for all of their clients. And so you have to reserve them really early in the morning. So you have to wake up, and if you see a stock as the leading gapper, so today, for instance, I'm up $22,000. Let's see, and the leading gapper, where's my gap scan? Our leading gapper today was LIXT. Now, it's a 4.3 million share float, and if I pull this stock up in Lightspeed, LIXT, you'll see that it is not easy to borrow. A stock that's easy to borrow, like General Motors, you don't have to pay a fee to short it, but a stock that is harder to borrow, you do have to pay a fee to short it, and that fee is per share. So if you want to reserve 1,000 shares, which you can then have allocated to you, and you can trade around them all day long. You can short 1,000, buy it back, short 1,000 again, buy it back, short 1,000. But you've got those 1,000 shares that are yours to trade all day long. You have to pay a fee, and it can be anywhere from 1 penny per share. So 1,000 shares would be $10, or it could be 10 cents, 25 cents. I've even seen over $1 a share, which 1,000 shares would cost you $1,000 just to reserve it. So the problem is you're out of pocket your reserve fee. And so this is number two, you have to pay to reserve shares on hard to borrow stocks. So you're out of pocket to reserve those shares before you've even taken a trade. You're in the hole. Maybe it's $100, maybe it's $200, maybe it's $50. But either way, you're starting in the hole before you've even taken a trade. And then because you've reserved those shares, you feel kind of obligated to trade, because you've already paid. So if a perfect setup doesn't form, well, darn it, I've already borrowed these shares and I have to pay. Now, even for me, even for someone that is, arguably a fairly successful trader, I still had a problem with this, because in the morning, maybe there's 3 or 4 leading gappers. Well, it's a race to get the borrows on them. And so do I borrow shares on all of them? I'm typically trading right now to the long side anywhere from 30 to 40, 50,000 shares and higher. Reserving that many shares, I'm going to be out of pocket thousands of dollars in borrow fees before the day has even started. And then, of course, I still have commissions on top of it. So for that reason, I've had a broker, I did use a broker at one point that could find borrows of a lot of stocks, but you had to pay for them. And I just felt like I was having a hard time. And then by the time I was like, okay, I'm definitely going to trade this, well, the shares were gone. And then, so the first is availability of shares to borrow. The second is hard to borrow stocks, you have to pay for it. 3, a short sale restriction. So that means you can't hit the bid when a stock has short sale restriction. You have to wait to short on an uptick. So you have to be short on the ask. That would be like trading a momentum stock like GameStop as it's squeezing up and only being able to buy on the bid. Now, for what it's worth, yesterday I traded GameStop, and in one trade, I made over $100,000. I finished up $195,000 on GameStop yesterday. This was the trade right here where I made over 100 grand. And on my GameStop trades, you better believe I was buying at the ask. I was buying at the ask, buying as it was going higher. Now, if there was a long side restriction and I could only buy on the bid, I could only buy on a downtick. Oh my God, it would crush the momentum. And the market doesn't want to crush momentum to the upside. They only want to crush it to the downside. All right, so that's why we've got that short sale restriction. So that makes it a little bit more difficult to short these stocks sometimes. Now, they don't always have short sale restriction, but if they have it turned on. Number four, a higher risk just invariably due to the potentially unlimited losses that comes with shorting. You short and your loss theoretically is unlimited because the stock can go up higher and higher and higher and higher. That's a problem. In practice, you can always cut your losses, but I personally struggle because when I short a strong stock and it keeps going higher, I keep telling myself, well, this just makes it even better short, so I'm going to add. And that's a trader psychology issue that I have, but it's been something that I've been having a hard time breaking through. And then the fifth reason, and perhaps one that is most important right now, is that I can't short in a retirement account. So far this year, I'm up $1.2 million. All of it is in my retirement account. That's tax-free. So if I made $1.2 million shorting in my main account, then I've got to pay 39% tax on it, plus 6% state tax. I'm paying over 40% tax. So for every dollar I make, I keep only 60 cents if I short. But for every dollar I make to the long side, I keep the full dollar. So this all makes me a long bias trader. Now, you may be different. You may, for whatever reason, really see things more to the short side. Usually traders are either long bias or short bias. There's not a lot of traders that are really good at flip-flopping and going long and short and going back and forth. There are some that can do it, but most are really kind of, the eye is trained just one direction there. So if you do find yourself practicing some of these positions short or in the simulator and finding some success with it, I would certainly work with that. But I would also remind you that in most simulators, you can short anything. And in reality, availability of shares to borrow plus short sale restriction creates a little bit of an issue. So even if you choose not to be an active short seller, seeing the market through the eyes of a short seller is still important and can make you a better long bias trader. And so that's why even if you never plan to short, this chapter is still valuable. It will help you better understand the places short sellers go short, set stops, and cover for losses. While in a traded long side, I often think about what a short seller would think of this current price action. And when I'm short, I'm often thinking about what a long trader would think of the current price action. So it's good to have that added perspective, even if your focus is just one way or the other. But as always, with momentum trading, whether you're trying to go long or short a momentum stock, breakout or bailout is important. If you take a short and it's not working right away, that's not great. Same with long. So we want to cut those losses pretty quickly. Now, I would say the bull trap and bear trap, these are the two areas where we see some of the biggest whips in the market when we're trading these small caps that have momentum. So a bull trap is when we see a bullish pattern resolve and then immediately reverse. Now, that reversal can be from a number of things. It's often that it broke and then there was a big seller on the level 2 and it was unable to come back below that critical level, whether it was a half dollar, whole dollar, or it was the flat top or the first candle to make a new high. But what can create a higher likelihood of a bull trap, a stock that's well extended off the 9 EMA, and I'll move my video here just to this corner here for now. A stock that's well extended off the 9 EMA, a stock that already has made a really large move, anytime it's after 12 p.m. So afternoon, inherently, we have just a higher level of false breakouts. And if the stock number 4 has already shown a tendency for false breakouts. So as a short seller, you actually want to try to capitalize on those bull traps. Just as a long trader will try to capitalize on a bear trap, a short seller will try to capitalize on a bull trap. However, you obviously want to be careful not to get caught in a trap, right? So a setup that has a higher likelihood of becoming a bear trap is then going to be the inverse of a bull trap. So let me show you some examples. So this right here is an example of a bull trap. So we have the first 5-minute candle that makes a new high, or the 5-minute breakout from 4 up to 540. But notice this candle formation. You know, a little bit of a warning sign there because we have this sort of upper candle wick and then a quick and pretty hard reversal from about 550 down to 450, a full $1 a share pullback. You know, that's a bigger pullback than we typically like to see. It does sort of bounce back up, and we don't actually even get a first candle to make a new high. It just sort of starts fading lower. But as we look at it, it certainly seems like we have a pivot here at 485. And that actually lines up with the first 5-minute candle to make a new high, which happened right here. But the red flags we have so far, topping tail, extended off of the 9 moving average, which is down here. You can see that. And it breaks 485, and it goes up to 495. It even goes up to 5. It breaks over 5, and then immediately comes back below. Now, when that happened, could there have been a 25,000 share seller at 502? Maybe. Could there have been a 25,000 share seller at 5 and it went 20, 19, 18, 17, 16, 15, 14, 13, 12, 11, 7, 5, 4, 3, 2, 1, and then it pops over that level, and then there's another big seller at 2 and immediately reverses. Anyone that got in immediately bails out. So the level 2 in the time and sales likely would give us some indication perhaps that this was about to happen. And that's the place where someone who just bought right here for the breakout or added for the break of 8 is going to want to cut the loss quick. It's where a short seller who's watching the stock and waiting for that opportunity is going to strike and go short, stop at the high. And that's where you get this big whip. So this high volume is a combination of people going short and long traders bailing out. So we have double the selling than what we would typically have. That creates that big flush. And now at this point, you have a broken chart, because you have this nasty false breakout. So from this point forward, being short bias makes sense with a stop up here. Now, it doesn't make sense if you shorted at the very bottom of this candle necessarily, but if you got an entry up here right around that false breakout, that could be a good spot to be holding it short. This is another example of a bull trap right here. So you can see that right there. It pops up, it breaks through that level, and then just immediately reverses. So it's just not able to hold. Now, let's see. So we've got, and that was the false breakout right there. Now it does come back up a little bit later, right here in the afternoon, and it breaks, but it's not before doing a couple false breakouts. Now here's another one. Now I'm just showing you examples. We're going to get into 5 unique setups for this, for shorting momentum stocks. And false breakouts are certainly one of them, but I just wanted to kind of run through to show you these again, double top right there. So we've got double top, and maybe on the level 2, we saw a big seller there. So these are places where certainly as a long bias trader, if you bought first candle to make a new high, and then you're adding for the break through the high, and then you see that big seller, that place where you're like, uh-oh, I got to bail out, that could be the same place where a short seller is going short. Sometimes, and again, this isn't my strategy, but sometimes the right move is to sell and flip short, but I don't usually like to flip-flop. All right, there's a nasty false breakout right there. False breakout, but what were the warning signs? Extended off the 9 moving average. 3 dojis in a row with a big topping tail. But this is a really dramatic false breakout up to 420 and then down to 380. And then this becomes a bear flag. It pops up for a second and then goes lower. The chart is broken. Right here, first candle to make a new high, topping tail, and then immediately comes back down. False breakout. Another one right here. This one actually did definitely a false breakout right in that candle right there. You can see that. False breakout, comes right back down. This one, another false breakout right there. And again, warning sign that it's a little extended off the 9 moving average. A little bit of a topping tail. Not a perfect bull flag. Now this one is interesting because this right here on this candle was a little bit of what we would call a premature bull flag breakout, where, you know, it pulls back and then it starts to break out there a little early. So it's right on this candle. It kind of pops all of a sudden from 840 up to 860. It does make a new high and then it immediately reverses. So that's a bull trap. Then it drops and breaks through the low, right? So traders shorting it and long traders bailing out. But then the fact that it comes down here and immediately bounces back up, this right here is actually a bear trap. The short, for anyone that shorted for the break through the low, then as it rips back to the high, all of a sudden now you've got short sellers getting squeezed out. So it was a premature breakout that created a bull trap. Then the flush down there, because it didn't bear flag and drop lower, became a little bit of a bear trap. Looks like I've got that slide in there twice, so let me pop that out. Let's see, 1, 2, 4. Yeah, oh, I changed the title of it on the second one, so I'll keep the second one. All right, and here's another one. So false breakout right there. So we get the pullback, false breakout over this pivot. Then it flushes, breaks the volume weighted average price, and then there's a false breakdown. So a bull trap and a bear trap. Then it rips back up to another bull trap right here. It drops down, it tries to get back above VWAP, and maybe you'd call that a bull trap again because it got above VWAP and then sold off. But really this was a bear flag and it was so weak, probably wouldn't have been worth trading. And you can see, you know, this is when sometimes you see the stock break out and you're like, boy, that's a funny breakout. That's a funny spot. And sometimes you'll chase. And that's, you know, when you chase these, that's when you get yourself into trouble. Because if it's not a really good setup, you have a much higher likelihood of a false breakout. Now right here, bull trap and bear trap. So there we've got the bull trap, the false break through the high, instantly reverses, flushes to the low, and then comes right back up. Now that can be super frustrating. If you bought for the breakout, you stop out for a loss, then you see it come right back up. However, what I will sometimes do is I'll say, okay, if this actually is showing this amount of strength to come back up, I'll watch it right in here because this could squeeze out short sellers who are shorting here, here, and maybe down here now as it's ripping back up, right? So breakout or bailout, don't stay trapped in the wrong direction. If you're trying to predict the change in trend, if you're trying to short a bull trap and then it rips back up, you could be caught in a bear trap. If you're trying to short a flat bottom breakdown or a break of VWAP and it rips back up, you may be caught in a bear trap. So you don't want to hold those losers when you're trading against the trend. There's no preventing these losing trades entirely. We all have losses from time to time. The best course of action is just to immediately unwind the position, which is to start selling, to start covering it or selling, on, you know, reducing your position, and accept the loss before it gets bigger and bigger. Averaging down, that can be a recipe for disaster when you're trading against the trend. When you're trading with trend and you're buying a dip, possibly averaging down can be okay if the stock generally is still within the trend of holding above the 9 moving average or maybe holding above the VWAP. That's different. When you're trading against the trend and it keeps going higher and higher and higher and higher, and you're just adding more and more and more and more, and it hasn't done that capitulation squeeze, then when it finally does that squeeze, that's when you're bailing out. And you just got caught right in what the long traders were looking for. So bear traps can happen in any pattern. Bear flags, flat bottom breakdowns, whole dollar breakdowns, VWAP fades, and then a bull trap is the inverse for long traders, and they can happen in any pattern as well. So the 5 momentum, the short side strategies that we're going to talk about, shorting momentum setups, will be shorting a false breakout, which is what I was just kind of showing you, shorting a trend reversal, shorting a halt resumption, shorting a bear flag, and shorting at the volume weighted average price. All right, so let's get into the first setup of chapter 10, shorting a false breakout.